We do believe, and our conviction has increased, that Bitcoin is the first global, digital, private, meaning no government oversight, rules-based, most important part of it, monetary system in history. That is a very big idea.
Cathie Wood is doubling down, not backing off. She says ARK Invest's conviction has actually increased. Bitcoin isn't just another asset. It may be the first truly global, private, rules-based monetary system in history. No central authority, no government manipulation. But she also acknowledges reality. In emerging markets, where people live hand to mouth, Bitcoin hasn't been the primary escape from currency collapse. Stablecoins, backed by the US dollar, have stepped in as the practical insurance policy against devaluation. That shift, she admits, trims ARK's long-term bull case slightly. Their famous $1.5 million 2030 target could be reduced by $200,000 to $300,000. Then comes the interesting part. Gold has gone parabolic, yet Bitcoin hasn't followed. If Bitcoin is digital gold, shouldn't it move the same way? Cathie points out something critical. Since 2019, the correlation between gold and Bitcoin has been surprisingly low. In other words, Bitcoin isn't just digital gold. It's evolving into its own asset class. From a broader market perspective, that divergence could actually be bullish. Gold rallies when fear dominates. Bitcoin tends to explode when liquidity expands and institutional capital rotates back into risk assets. If macro conditions loosen into 2026, Bitcoin may not follow gold. It may outperform it. If you're finding value in these insights, like, comment, and subscribe as we continue bringing you more powerful clips from Cathie Wood's interview.
Now, what has happened in the last year or so, stablecoins have been usurping one of the roles that many of us thought Bitcoin would play. In the emerging markets, people who are living hand to mouth, meaning they don't have a lot of savings, they would much prefer the dollar. And stable coins are backed pretty much 100% by dollar or dollar-based assets. And so that is their preferred insurance policy against their own currency's devaluation and the loss of purchasing power and wealth. So from that point of view, in our long-term forecast, which our bull case for 2030 has been $1.5 million, that would have taken $200,000 to $300,000 off of that price target. But what else has happened in the last year? We've seen gold really go parabolic, and Bitcoin has not done the same. Well, how can that be? It's digital gold, we thought. Well, if you look at the correlation between gold and Bitcoin, you'll see it's very low, especially since 2019, since more traditional investors have been getting involved with it. The correlation is 0.14, so almost no correlation. But if you zoom out and you look at the longer term price chart of Bitcoin, what you'll see is gold often leads, and certainly in the last two cycles, Bitcoin's performance. So gold is a leading indicator in at least the last two cycles. We think the other thing going on is we're seeing a lot of OGs selling. Those who were very early adopters of Bitcoin are selling. Now, why are they selling? Well, according to some of them, Bitcoin has lost the plot. Too much traditional finance or financial players are getting involved. And from our point of view, all along, and this is in our collaboration with Dr. Arthur Laffer, known for the Laffer curve, he has said the more that Bitcoin becomes involved in the traditional financial ecosystem, meaning traditional financial institutions start adopting it, the stronger his conviction will be that it is indeed the new global monetary system I described. So our conviction has actually gone up as Bitcoin has gone down here. Bitcoin is a hedge against inflation and deflation because the chaotic part of this is, and it's ripping through the markets now. A lot of traditional industries and companies, being brought, the whole SaaS space, the disaster, as they're calling it. We think there is merit to that particular one, but I think you're going to see disruption all over the place. Because the 5 innovation platforms that I mentioned are going to disrupt the existing world order. And what does that mean? If these technologies are so deflationary, it's going to be tough for the traditional world that's gotten used to sort of the 2 to 3% inflation, to adjust. They'll have to embrace some of these technologies faster than expected. So the idea of counterparty risk, I think, is beginning to surface. We've seen it with First Brands. We've seen, private equity and private credit, especially, is where there have been a lot of excesses. SaaS, they are too exposed to that. Are we going to see counterparty risk manifest more broadly? If so, Bitcoin, it doesn't have that problem, and so it is a good hedge against deflation as well as inflation.
Michael Saylor looks 21 years out and expects roughly 29% average annual returns. Not straight up, not easy. A serpentine pattern, massive rallies, brutal drawdowns, but trending higher over time. Volatility isn't a flaw, it's the feature. He argues Bitcoin is the only global asset trading 24/7. If geopolitical chaos hits over a weekend, you can't trade stocks, real estate, or gold, but you can trade Bitcoin. That makes it the most liquid and the most reactive asset on Earth. Traders move billions into crypto exchanges because they can buy, sell, panic, and capitalize instantly. When Bitcoin drops 5% on a Sunday, someone is panic selling and someone else is scooping it up at a discount. That capital isn't flowing into Nvidia, Apple, or traditional markets. It's flowing into Bitcoin. From a macro perspective, this 24/7 liquidity plus growing institutional adoption is why volatility remains high and why long-term upside remains intact. If you're thinking long-term, the weekend noise doesn't matter. The trend does. Let's get more of his insights.
Got 21 years, and I expect about 29% ARR over the next 21 years. I've always thought that we would have rallies and drawdowns, right? So I see it as a serpentine pattern, where it's just slightly less than 30% over time, but there'll be periods when it will surge and there'll be periods when it will draw down. That doesn't change. Well, if something happens in the Middle East, Bitcoin will be the only thing you can sell. It'll also be the only thing you can buy. And so that just means that a lot of people that want to trade on the weekend are transferring capital to crypto exchanges so that they can either buy or sell, buy, sell, and buy Bitcoin 4 times between Friday at 4 p.m. and Monday morning at 9:30 a.m. And yeah, if you're a trader, what does that make this? It makes it the most interesting asset in the world for you. If you're an investor over 4 years, what the heck difference does it make whether or not it gets bought and sold this weekend? In fact, here's the difference it makes. There's capital, hot money, that's flowing into this ecosystem, into the Bitcoin ecosystem, that otherwise would not be allocated, right? There's a trader, someone's got $20 billion of capital, and their choice is they can either leave it in the bank earning SOFR, or they can put it into the crypto exchange system, and they can buy and sell and buy and sell, and maybe they'll make 4% this weekend. Right? When Bitcoin crashes by 5%, there's someone buying while there's someone selling. So people are like, oh, it fell 5%. Well, someone woke up at 4 a.m. on a Sunday morning to buy it at a 5% discount. So someone's going to actually make more money on the weekend than they would make holding conventional money for a year. And that capital is not flowing into New York City real estate. It is not flowing into gold. It is not flowing into conventional derivatives. It's not flowing into NVIDIA stock. It's not flowing into Apple stock. Why? Because you're not buying and you're not panic selling and rage quitting and buying and capitulating and, and leaping into the market on these volatility waves. So Bitcoin is most volatile because it's most useful. Okay. So Bitcoin represents the global capital market. And there are people doing things that you can't do, that you won't do, that you don't choose to do, you don't wish to do, and they're doing it with that asset, and that's what's creating the volatility. But it's also creating the gravitational or the magnetic field, which is attracting all of the energy, all the financial energy of the world is being drawn into this space, all of the political energy, all of the digital energy, it's all being drawn into this space because of that utility. And I think you just got to make your peace with it. Either you're short term and you're a trader. If you're worried about what Bitcoin's going to be in 4 days or 4 weeks or 4 months, you're a trader. Call yourself a trader. And then you better have a trading methodology or trading excellence, or be in the trading business, or be neutrally hedged so it doesn't matter to you. You're either that, or you're an investor, you've got a 4-year time horizon, and then it just doesn't matter. All you'd be thinking is, a lot of capital is surging into the space, and a lot of attention is being given to the space that otherwise would not be given to the space because of those crazy traders. And let's just let them do their thing because I'm an investor, I'm holding for the long term.